Good morning, everybody, and welcome to the first quarter Nedgroup Investments Fund Manager Workshop. My name is David Levinson of Nedgroup Investments, and I'm very proud to host you for this morning's session. We do have a very full schedule, and I imagine, like me, you're looking forward to gaining clarity and making sense of what is happening in the market at the moment, which has been a very interesting space to be in. And without further ado, I'd like to welcome Walter Aylett, who is a portfolio manager of our Bravata Worldwide Flexible Fund, and I think no better place to start. Walter, thank you so much for joining us today.
Oh, sure. As we've discovered, every minute changes, and so it's really pointless talking about what happened the last day or two. I think the lesson we've learned from the GFC and COVID and now this time is that the future doesn't really matter because you can't forecast it. I think what's pleasing for us is when you look at the performance of the fund, over all periods, it tends to keep a very positive return over 3-year rolling periods. And we've faced many crises over its 20-year time horizon. So I think we're in the same place again. This time, I think also we'll probably be the best placed, simply because since, if you remember Bernanke's taper tantrum, we've been quite negative since then. And this can has been kicked down the road since 15 years. There's no more can to kick. So we have the next 5 to 10 years, a high inflation environment, high interest rates, confidence gone, tariffs. We see no positive things happening in the USA in particular and the globe. So in terms of performance, we've got lots of cash, about 20%. And you can see there in this slide over here is that over most periods, all the periods, we have a positive absolute return. And I think it's owing to the fact that we tend to be a bit different to the rest of the crowd. And we manage for a 5 to 10 year time horizon. And a lot of that performance comes from owning an investment, say like Berkshire Hathaway, which we've had for almost 20 years in the fund. And and that it's tough to do that. Not many fund managers will do that. And that's why that performance is the way it is. It's a mature way of investing, or a rational way. There's no quarteritis in those numbers. So again, if you look at the next slide, these are the contributors. Again, those are the type of companies you won't see in most funds. And in terms of contributors, those are stocks that we've owned for quite a while. And the negative contributors are short-term in nature. Dollar General is a recently invested company, and Ruby and BBW are just suffering short-term performance, but there's a big divvy coming out of Ruby.
Yeah, I remember those Bernanke years quite well. I was actually working in London at the time, so that everything they were trying to do from a federal bank point of view was very interesting, and maybe we can touch on that towards the end of the session. For me, what's quite interesting on this page is British American Tobacco. If I rewind sort of maybe 5-10 years ago, there was all that regulatory talk in the US, and the tobacco stocks generally had quite a tough period, but they seem to have weathered that, and maybe tobacco as a product has shown itself as to be that inelastic product that
Well,
that it
I
once
think
was.
it's not only about tobacco, it's about nicotine. And as they switched from combustibles, which is cigarettes, to non-combustibles, which are next generation products, it's vaping, and then we now have these little cushions that you put in your mouth, these, I think they're called Zyn, that Philip Morris makes, which are loaded with nicotine. That's very interesting for us. And nicotine's never been proven to be bad for you. It's the other stuff, the tar concentrate. So we think we've been paid a dividend yield of 10% a year to watch people chew these little Zyns and smoke hopefully healthier vaping, or inhale, should I say.
Yeah, I think it has shown its resilience through time. And then
so in a similar vein, investors will notice we've upped our alcoholic exposure, if you want to call it, beer, spirits, single spirits like tequila. And we think alcohol companies are going through the same thing that the tobacco companies have been going through. And if you look at this chart, going way back, the proportion of adults haven't really dropped in terms of alcohol intake. And then when you break it by age groups, you can see most of the alcohol reduction has been in the young people as they've moved towards recreational use of drugs, should I say, be it cannabis or who knows what else they ingest. But as you get older and you get more income, you kind of go back to the norms. And we think the same thing's going to happen. I frankly look around on weekends and I just see young people drinking just as much as we used to drink. Now I'm in an emerging market, and that's the one big difference, is a lot of the fear in the market, besides young people not drinking anymore, is this move towards these diabetic drugs like Ozempic, where you won't maybe drink as much as you would. But we don't think that's the case, particularly in emerging markets and other non-USA markets. And and as you get richer, you want to drink beer. And a simple thing too, if you think of zero alcohol beer, you're able to advertise that. So when you watch a football game, you'll see Guinness around the field. That effectively is advertising for the alcoholic beer as well. So, and there's no taxes in zero alcohol beer. So I think the outlook for alcohol companies is very good over the next 5 to 10 years. And we are paying very little for that, the certainty. And the other thing is that in this uncertain world, I would rather invest in boring, low multiple companies where I have a fairly good idea what the outcome looks like. And the product is not a grudge purchase.
And my gran was Catholic, and she often reminded me the priests or the monks were the first to invent beer all those centuries ago, and it's really stood the test of time.
Yeah, and wine came out of Iran.
Yeah,
sure was.
And full disclosure, I had a 0% beer yesterday after a round of golf. So there's a little bit something for everybody.
And it's getting better. The quality of these zero alcohol beers are getting better, and now we see wine are trying, but I don't think it's going to work.
0% wine. Yeah. Okay, I haven't heard of that one.
The French are trying very hard.
Oh, surprise. And then, the performance chart you showed initially there showed, I guess, the quality side, particularly as we kind of went through that COVID unlock, and the fund did really well for clients. I think the next slide or this slide.
So what I've done here, this is the global fund. We have a small exposure to the Aylett Global Fund, and we're not really trying to promote Aylett Global Fund. But what I think it does is it's a very objective way of identifying how good our stock picking is. And for the first 2 years, we invested in companies that were out of favor. And as you get this meltdown, as we saw in 22 and as we're seeing right now, our investment picks have done really well. We don't own the Magnificent Seven. We are very little exposed to the USA. And we have more of a UK, Europe, emerging market exposure via certain companies in Indonesia and so forth. So all we're just trying to say is this is our style of investing. And typically, you want to invest in an Aylett fund or a Bravata is when they appear to not be doing well. And all we've done is we've invested in unpopular investments. When the market corrects like it has now, those unpopular investments go down with the market and gives us another chance to buy. And then typically they recover very fast because the earnings are intact down the road, and you haven't paid for future growth. And then you get this wonderful dividend in the meantime. The dividend yield on this fund is very high. And I like that.
And then the next slide, I guess, speaks to the rolling 3-year.
Yeah, we're just trying to show is that in all this thing, you get a positive return and not a negative return, despite the fact we have all this optionality on equity investments.
Yeah, just if you think about everything we've been through just in the last sort of 16, 17 years, there must be something really to be proud of to be in the positive territory through that whole period.
And also if you take in my previous life, in my other fund that I manage, which is continuation, Bravata, it's the same thing. And in fact, it's just the way we invest. We don't have the pressure that most fund managers have, which is to manage funds by the quarter.
Now, I'm hesitant to go there, but we have to because on a forward-looking basis, Natalie, my colleague, and I were in your offices the other day, and you kept having to shoot out because the markets were moving by the minute.
Well, it was also I needed to go to the bathroom. I'm 64.
So maybe for those of the fund, talk a little bit to the outlook side, how you positioned.
So we have no idea what the future holds, and we never have and never will. I think history is a great teacher in what we think outcomes will be. And I think this time, and the most dangerous word in investments, this time it's different. But I do feel that what President Trump has done has moved America from a global power to a regional power. And the consequences are going to be felt not only within the USA, but across the world. So we have to go back to the 70s and see what happened when you had similar circumstances. It's not good. So we're going in. generations have never experienced interest rates at 7, 8, 10% in the States. They need us to lend money to them. We're not going to pay them 5, 4%. We want a higher return. People don't want to visit the USA. People don't want to do business with the USA. And we know half the people in America don't believe in Mr. Trump. Yeah. That's not the point. We don't want to do business with them. So, and I think it's going to take many, many years for that damage to be repaired, if ever. That's an 80-year relationship that you've destroyed. Yeah. And you can say what you like, but half the USA voted for him. And so ultimately, I think we as an investor should be prepared for a very low return environment of between 0 and 5% per annum. And hopefully we're wrong. Yeah. And it's not negative.
Yeah, well, I mean, they're 15% of global trade, I think, these days, and whether that galvanizes that remaining 85%, and you see new multilateral arrangements happening on the trade side, not sufficient enough to weather what Trump is doing.
No, we're all going to suffer, but I think we're going to get a unified Europe. I expect Britain to join Europe again in the next 5 to 10 years in some form. Unfortunately, some of the bad guys are going to get stronger, like Russia, and I don't want to say China's a bad place. I mean, it's a 1.5 billion people, and maybe you've got to manage the country the way they do, but they are certainly much stronger now than ever before than they were a year ago. And little Africa, South Africa, this little fishing village down here called Cape Town, I think we're in a good place. We just need our government to take the advantage of the situation and encourage investment this way in tourism, because we are in a sweet spot potentially, but we need to get out of the way of business and instruct business to go for it. And then we're game, set, match. Okay. And we can blame Mr. Trump.
And sounds like you have an edge of optimism there for South Africa.
We think if we had none of the issues that we face in South Africa today, we'd be 100% South Africa. We're about 20%. Okay. There are so many great assets in this country. I mean, I'll give you an example, and I'll leave you with this. I went to a very good fish restaurant which imported salmon from Scotland or Norway. It cost for that and the vegetables and all that, which were world class, $15. Come on, that's an imported product, and you're charging me only $15. This is a top-end restaurant. So there's so many opportunities. We have an edge. We have a competitive advantage. We're nice people. Let us invest and work hard.
And then maybe a parting question before we go, the third bullet there about the inflationary effects of tariffs. So the US Fed, you spoke a bit about the Bernanke years. How much is their focus going to be on this tension between interest rates, which, inflation supposedly going up with all these tariffs will affect the price of goods? So would they look to control inflation through interest rate mechanisms? Or the fact that they're thinking more about growth and therefore the more willingness to...
So I don't know. I've learned with governors to listen to them and believe them and not outthink them. I think the president or the Fed, Mr. Powell at the moment, is very independent in his thinking. I have no doubt, absolutely no doubt, if there's a deep recession, they will come and assist. We've never seen stagflation, it's rising inflation and high unemployment. We will wait to see how that plays out. He's got a 2-year term left, or his period expires next year, sort of, because he still remains on the board, but for another 4 years. But the truth is we don't know. But I like to think that they talk about price stability, with whatever that means. He will come to the party and assist, but that's not going to help the states, no doubt. There's going to be so much lack of confidence in fighting. The politics is going to be ugly, even to the point where you've made promises to soldiers, to policemen, to firemen. You risk some kind of civil disturbance.
Sure, I feel like we could chat all morning, actually, going from China's position.
It's so
what
easy
they're doing
to talk
in the
about
US.
things you know nothing about.
Yeah. Well, I mean, uncertainty, and we've seen the market doesn't like uncertainty, but
I like uncertainty.
You like uncertainty?
Yeah,
okay.
I think it gives me good.
Also, full disclosure, before today, I had to Google Bravata. It means bravery and courage from Italian.
We chose that label 20 years ago. We tried to do bravura, but someone else said it, which is an aggressive way of playing music.
Yeah.
So bravata.
Well, maybe it's a time to be brave with everything that's happening in the markets. And I think that rolling through your chart is something
I think I've been brave enough.